Sagely investors, welcome back to the channel. My name is Kras. To fully understand what the dividend yield trap is, we're going to have to look a little bit more closely at the dividend yield and define that with a lot more accuracy than you're going to find anywhere else. So here's my proposal. The dividend yield is defined as the most accurate known amount of dividends that you expect to receive over the next 12 months divided by today's stock price. Okay, that was a bit of a mouthful, so why don't we just define it as dividends in a year divided by today's stock price. But keep that tighter definition in your back pocket throughout this video. Now, to really understand the principles behind the dividend yield trap, here are 5 examples that I've prepared earlier. Alright, let's dive in. As you guys can see from the chart here, we're looking at AGL Energy Limited, which is listed on the ASX under the ticker AGL. Now, we're looking at the last 10 years worth of data, and over here to the right, we can see the last 10 years worth of dividends. The dividend yield at present is 11.3%. So the question that an investor might ask is, can I expect to continue receiving 11.3% into the future if I invest in today's stock price of $8.14? Well, the answer is complex, and the answer is that I personally don't know. First of all, let's find out how the 11.3% is calculated, and this will really help you guys understand what I mean with my original definition. So let's scroll up here and take the most recently paid 2 dividends, which were paid on the 26th of March 2021 and the 25th of September 2020. So let's take the calculator out, add them up, and then take that number and divide it by today's stock price. So as you guys can see, I've just shown you how the dividend yield is calculated. And this is the dividend yield trap. The reason why a company like AGL would have such a seemingly high dividend yield is because the dividend yield is calculated using historical data. And if you guys understand that concept, then you've understood the dividend yield trap, because let's take a look at this stock price chart a little bit more closely. Something happened in 2019 that changed the business fundamentals of AGL, or investors perceived the business fundamentals of AGL to have changed. And there has been a significant sell-off over the last 2 years. So investors are expecting reduced revenues when the price goes down. So the reality is that this 11.3% dividend yield may not be sustainable into the future, and it's very likely that it won't be. Now, the kicker is that if you do enough research in a company like this, and you fully understand the fundamentals behind it, then you can take advantage of low stock prices like this, buy it today, and potentially, if your theory is correct, the stock price will recover. Alright, let's move on to the next example. Washington H. Soul Pattinson and Company, which is listed on the ASX, a dividend yield of 1.79%. This is about 7 times lower than AGL's dividend yield. So what's going on here? Well, if we look at the stock price, you can see that from the middle of 2020 until today, it's had a big significant increase in the stock price. And if we look at the company's dividend history, you can see a very consistent dividend increase over every single year as far as the data goes back. Now, again, you would have to do a lot of research behind this company to fully understand why the price is so high and why the dividends have been so consistent, to fully understand whether this company is a good, solid investment. Next example, Woolworths. In this example, I want to show you guys how the stock price affects dividends and potentially the dividend yield. So if we look back at 2014, when Woolies shares were trading at around $31, $32, we can see that something significantly changed over the next couple of years going into 2015 and 2016, where the stock price fell to $18. Now, if you look at the dividends the dividends only really started falling around 2016. So back in 2014, investors could see a reduction of revenues on the horizon. And there was a big sell-off in October of 2014, and that sell-off continued for the next 3 years. But as we can see here from the chart, 2015 they paid the same amount of dividends, so the dividend yield at the time would have been increasing, leading some investors to believe that Woolworths would continue to pay this high dividend, not knowing or not realizing, because they hadn't done enough research, that over the next say 2-3 years there would be significantly reduced dividends, probably because of reduced revenues and profits. Now for the next example, we're going to look at Macquarie Group Limited with a dividend yield of 2.99%. Now the question that you might ask yourself looking at this chart and looking at these dividends is, why has Macquarie's stock price exceeded the pre-COVID stock price in January of 2020 today, in July 2021, but the dividends have not kept pace? It doesn't look as though the dividends have exceeded the pre-COVID dividends. So what's going on? Well, again, you really need to understand the fundamentals of each individual company because they all have a different story to tell. For instance, Macquarie could have retained more of their profits as retained profits rather than paying dividends in 2020 and 2021, and they could have used that money to invest in non-dividend paying assets, hence the reflection in their stock price. Alternatively, they could have kept the same dividend payout ratio of 60%, but their future prospects have materially increased over the last year. Again, I don't know what the answer is. You need to do your own research to really understand and find out what the situation is behind every company. Final example I want to give you guys is a very interesting one of Fortescue Metals Group with a huge dividend of 10.42% today. Now, very quickly, if we look at Fortescue's stock price over the last 10 years and we open up the iron ore price over the last 10 years, we can easily see what's going on. We can see that over the last 2 years, the iron ore price has had a significant run-up, and Fortescue's stock price has also had a significant run-up. Clearly, they are making more revenues and more profits, and they're paying higher dividends, so investors are loving this. Now, the question you might ask yourself is, why haven't investors driven Fortescue's stock price all the way up to, say, $30, $35 and bringing the dividend yield back down to 5%, which is a more reasonable range? Well, one answer could be that this level of iron ore prices is simply not sustainable in the long run, hence the higher dividend yield or the lower stock price. So guys, I hope this video has given you a much clearer picture on the dividend yield trap and what you can do to avoid it. The only way you can avoid it, guys, is to really do a lot of thorough research. There's no way around that. Don't forget to leave a thumbs up on the video if you enjoyed this content, and I'll catch you guys in the next one.